Hello everyone, this is Darko 2012 and I'm reading an article posted on Infowars.com by Bob Chapman, the international forecaster, dated November 29th, 2009. Potential for Fed to hyperinflate. It's kind of a long story, so it may be a two-parter, but it is a very, very good article. So here we go. The following information may be the most important we have ever published. One of our intel sources, highly placed in the banking circles, tells us that on 1/1/10, all banks that have received TARP funds have been informed by the Federal Reserve that they must further restrict any commercial lending. Loans have to be 75% collateralized, 50% of which has to be in cash, which is compensating balance. The Fed has to do one of the two things. They either have to pull 1.5 trillion out of the system by June, which would collapse the economy, or face hyperinflation. This is why the Fed has instructed banks to inform them when and how much of the TARP funds they can return. At best, they can expect 300 to 400 billion plus the 200 billion the Fed already has in hand. We believe the Fed will opt out for letting the system run into hyperinflation. All signs tell us they cannot risk allowing the undertow of deflation to take over the economy. The system cannot stand such a withdrawal of funds. They also must depend on assistance from Congress in supplying a second stimulus plan. That's right, everybody, a second stimulus plan. The automakers are already asking for a cut out of the stimulus, a second stimulus that hasn't even been brought up yet, so it's coming next year. That would probably be $400 to $800 billion. A lack of such funding would send the economy and stock market into a tailspin. In other words, pass the bill or there's going to be martial law again. Even with such funding, the economy cannot expect any growth to speak of, and at best, a sideways movement for perhaps a year. We've been told that the FDIC not only is $8.2 billion in the hole, but they have secretly borrowed an additional $80 billion from the Treasury. We've also been told that the FDIC is lying about the banks in trouble. The number of imminent danger are not 552, but a massive 2,035. The cost of bailing these banks out would be $800 billion to $1 trillion. That means 2,500 could be closed in 2010. Now get this. The FDIC is going to be collapsed before the end of the 2010, which means no more deposit insurance. This follows September 18th, 2009, end of the government guarantees on money market funds. Both will force deposits into U.S. government bonds and agency bonds in an attempt to save the system. This will strip small and medium-sized banks and force them into shutting down or being absorbed. This means you have to get your money out of banks, especially CDs. We repeat, get your cash values out of life insurance policies and annuities. They are invested 80% in stocks and 20% in bonds. Keep only enough money in banks for 3 months of operating expenses, 6 months for businesses. Major and semi-major banks are being told to obtain secure storage for new currency dollars. They expect official devaluation by the end of the year. We do not know what the exchange rate will be, but as we have stated previously, we expect 3 old dollars to be traded for 1 new dollar. The alternative is gold and silver coins and shares. For those with substantial sums that do not want to be in gold and silver related assets completely, you can use Canadian and Swiss treasuries. If you need brokers for these investments, they can supply them. That's at the financial forecaster, Bob Chapman's website. The Fed also expects a meltdown in the bond market, especially in municipals. Public services will be cut drastically, leading to increased crime and social problems, not to mention the psychological trauma that our country will experience. Already 50% of homes in hard-hit urban areas are underwater. Nationwide, more than 25%. That means you have to be out of bonds as well, especially municipals. As you can see, the Illuminous program is going to come quicker than we anticipated. That in part is because we all have had to expedite their program due to exposure in the IF, other publications, and especially via talk radio and the internet. There is no doubt we have the elitists on the run. We are reaching the masses. On TalkStreamLive.com, we are on the rumor mill this past week, and out of 50 talk radio programs, we are 5th behind Rush, Hannity, Dr. Laura, and we were tied with Beck. On the Sovereign Economist on Wednesday night, we were fifth behind Beck and Savage and ahead of Hannity. Both of these programs are not well known, and the Sovereign Economist is only about a month old. It shows you what you can do if you work hard enough. The latest favorable events, we were told, are the seeds of recovery. The green shoots of spring are to be harvested before winter sets in. We are skeptical of the strength and duration of such recovery. The underlying problems are still not addressed. The U.S. government and the Fed cannot bail out banking, Wall Street, insurance, and government indefinitely via monetization. Impaired corporations, no matter what their size, have to be allowed to fail. Stimulus cannot be used indefinitely. Both have to be reined in, because the longer this charade continues, the worse the final outcome is going to be. As we predicted 6 years ago, Fannie Mae, Freddie Mac, Ginnie Mae, and FHA are the wards of American taxpayers, as is AIG. All their financial conditions worsen every day. They have again been insuring subprime mortgages by the thousands. When they begin to reset next year, we will be back to 60% failure rates. Even government admits that already they see 20% failure rates. This so that housing inventory can be cut from 11.5 months inventory to 7.5 months, again in order to bail out lenders at the expense of taxpayers. Government and the Fed have no exit plans for these sinking ships, particularly Fannie, Freddie, Ginnie, FHA. Never mind their meddling in the economy, guaranteeing everything is sight. Benito Mussolini would have been very proud of what they have done. And of course he's referring to corporatism, which is big government and big corporations. Everybody knows that big corporations love big government. They don't hate them. They survive and they thrive off big government. Moving on. Then we have those on Wall Street, banking, and corporate America who believe they are doing God's work by looting the American public, making outrageous profits by in part using taxpayer funds, and allotting themselves disgraceful bonuses as unemployment hovers at 22%. Haven't these people heard of the French Revolution? Their arrogance has no bounds. The credit crisis hasn't ended. The Fed has extended it by throwing money at its problems. We have a mortgage market that is worse than it was a year ago, only kept from sinking by a tax credit 3% down. As a result, now we have more than $1 trillion of new mortgage failures on the way. Our monetary base has more than doubled. Interest rates will probably stay where they are for 18 months or more, and we even have a dollar carry trade. The 2009 fiscal budget deficit was $1.5 trillion, and 2010 will be worse. Government is not cutting expenses; they're increasing expenses. It's almost over. In addition, making matters worse, corruption is flourishing via the incestuous revolving door between Wall Street, the Treasury, and a municipality of other appointments, and with the Fed. Is it any wonder 75% of Americans want the Fed audited and investigated? That said, the present set of circumstances cannot be allowed to go on indefinitely. We cannot keep insurance, Wall Street, and banking on life support forever. Not when we finance two occupations in ongoing war, never mind our unfunded liabilities of Medicare, Social Security, etc. Most all of these problems are being financed by debt to be paid by our great-great-grandchildren. We just created $12.7 trillion for bailouts, and the Inspector General tells us we are presently on the hook. We are presently on the hook for $23.7 trillion. What happens if all the recipients need another $20 trillion? The situation is still dire, and the solution is temporary and unworkable, and Washington and New York are well aware of this. The game will be played out for over the next few years. In the meantime, the dollar will move lower and inflation, gold, and silver higher. Economics is not complex. It's very simple. Professors and economists would like to have you believe it is complicated when in fact they make it opaque, so you cannot understand it. The same is true with banking. In normal times through the centuries, bankers using the fractional banking system usually lent 8 times their assets or deposits. It was only until recently that the privately owned Federal Reserve told banks within the system to lend 40 times assets or more in order to accommodate the system. Part 2 will be coming up.